Because right now, one of these could quietly protect your wealth, and the other could slowly cost you more than you realize. They're both silver. They look the same on a price chart, but when premiums explode, when liquidity dries up, and when you actually need to sell, they behave very differently. Some stackers swear by old US coins. Others trust clean, modern bullion bars. But here's the part most people miss. The wrong choice at the wrong time can lock you into higher premiums or force you to sell when you don't want to. By the end of this video, you'll know exactly which one fits your strategy, and which one could quietly work against you. And the biggest difference comes down to something almost no one talks about. Welcome back to Market Metal. Now, before we go any further, if you're watching this and you've been around the block a few times in life, you've seen markets change, rules change, and money change. So let me ask you kindly, like one grown adult to another, would you consider subscribing to this channel? No hype, no noise, just clear thinking about metals and markets. And one more thing, tell me in the comments, where are you watching from today? The decision. Most stackers get wrong. He had noticed a pattern forming quietly across the silver market. Buyers were no longer asking whether silver made sense. That debate had already passed. The new question was more precise and far more important. How silver should be owned. Not which coin looked better, not which product felt heavier in the hand, but which form of silver actually behaved the way buyers expected when pressure entered the system. To most people, silver was silver. An ounce was an ounce. A price chart showed one line, one number, one market. But this assumption, he understood, was where many otherwise rational buyers made their first mistake. Because while silver the metal was uniform, silver ownership was not. Different forms of silver moved differently through markets, premiums, and liquidity channels, especially during periods of stress. This mattered now more than it had in years. Across the global economy, conditions were shifting. Inflation had stopped being theoretical. Interest rates were no longer harmless. Supply chains were less predictable. Trust in monetary policy was thinner. In this environment, silver had returned to the conversation, not as a speculative trade, but as a defensive asset. And when defensive assets returned to relevance, structure mattered. The choice between 90% US junk silver and modern silver bullion looked simple on the surface. Both were silver. Both tracked the same spot price. Both were widely available. Yet beneath that surface, they operated inside very different market mechanics. Most buyers never paused to ask how premiums formed, or why liquidity behaved differently across products, or what happened when a dealer was flooded with inventory, or how easily an asset could be divided when partial liquidation was required. These were not academic questions. They were practical ones, and they determined outcomes when conditions tightened. The central problem, he believed, was that many buyers treated silver as an identity rather than a tool. They chose products based on preference, aesthetics, or habit instead of function. But silver, at its core, was a strategy instrument. And like any instrument, it performed differently depending on how it was built. That was the purpose of this analysis. This was not a forecast. It was not a call to action. It was not a prediction about where silver prices might go next. Instead, it was a structural breakdown of how two common forms of silver ownership behaved under real-world conditions, and how that behavior aligned or conflicted with the goals of serious capital holders. The first misunderstanding appeared early in the decision-making process. Many assumed that because bullion was newer, purer, and more standardized, it was automatically superior. Others assumed that because junk silver was old, familiar, and historical, it was inherently safer. Both assumptions missed the point. What mattered was not age or purity. What mattered was use case. In stable markets, differences between silver forms often seemed trivial. Premiums compressed, liquidity was abundant clair, buyers and sellers moved freely, but stability had a way of masking risk. It was during volatility, when demand surged, inventories tightened, and confidence wavered, that structural differences became visible. Premium behavior was one of the first stress indicators. When investor demand spiked, bullion premiums often rose quickly. In contrast, junk silver premiums tended to behave differently, sometimes lagging, sometimes flattening, depending on local supply. This divergence confused buyers who expected uniform pricing across all silver products. Liquidity was another misunderstood variable. A product could be liquid in theory, but illiquid in practice. Large bullion bars might be easy to sell on paper, but difficult to break apart. Fractional silver could move quickly in small transactions, but required more volume to store. Each advantage carried a corresponding limitation. Storage efficiency, often overlooked, also played a role. Entrepreneurs and investors understood space as a cost. Capital density mattered. 10 ounces of silver could occupy dramatically different volumes depending on form, which became relevant at scale. Then there was flexibility, the ability to sell part of a position without disturbing the rest, the ability to transact locally versus nationally, the ability to adapt as circumstances changed. These were not emotional considerations. They were operational ones. The mistake most stackers made was assuming there was a single correct answer. In reality, the correct answer depended on intent. Silver held as insurance behaved differently than silver held for trading. Silver intended for emergency liquidity served a different role than silver intended for long-term balance sheet preservation. This analysis began with a simple premise. The right form of silver was the one that aligned with the owner, S objectives, constraints, and exit strategy. Understanding that required stepping back from product marketing and focusing instead on structure. Only then could the real comparison begin. 90%. Junk silver. The quiet asset. Most people underestimate. They were often dismissed with a careless name. Junk silver. The term alone caused many modern buyers to look past it, assuming it was outdated, inefficient, or inferior to newer forms of silver. But those who had studied monetary history understood something important. Assets that survive multiple monetary systems rarely do so by accident. 90% US silver coins did not begin as an investment product. They were money. They circulated in daily life, passed through millions of hands, and functioned during periods of stability, inflation, war, and monetary transition. Long before bullion rounds existed, these coins were already performing their role. This history mattered more than most people realized. When silver prices rose sharply and when financial stress increased, something unusual often happened. Dealers reported steady demand for 90% silver even when premiums on modern bullion spiked aggressively. While bullion prices surged above spot, junk silver sometimes lagged behind, or at least moved more slowly. To casual buyers, this looked like inefficiency. To experienced ones, it looked like an opportunity. The reason lay in how junk silver entered the market. Unlike bullion, which was manufactured specifically to meet investment demand, 90% silver entered circulation decades ago. Its supply was finite. No refineries were producing new pre-1965 dimes or quarters. The only source of supply was existing holders willing to sell. This created a different dynamic, one driven more by local flow than by global speculation. Recognition was another quiet strength. A silver round required explanation. A bar required verification. A pre-1965 dime did not. Even people with little investment knowledge recognized it as real U.S. currency from a time when money contained metal. This recognition lowered friction during resale. Fewer questions, less hesitation, faster transactions. Liquidity followed naturally. Local coin shops preferred junk silver because it moved quickly. Private buyers trusted it. Even during uncertain periods, it retained a bid. It did not rely on branding, mint reputation, or packaging. Its value was understood through familiarity, not marketing. Then there was fractionality. This was where many buyers began to pause. A single ounce of silver bullion was indivisible without selling the whole unit. A 10-ounce bar was efficient to store, but inflexible to sell. Junk silver, by contrast, offered natural division. 1 dime, 1 quarter, 1/2 dollar. The owner could sell only what was needed and keep the rest intact. In periods of stress, this mattered. Markets did not always allow clean exits. Sometimes liquidity appeared in small windows. Sometimes partial sales were preferable to full liquidation. Junk silver allowed that kind of precision. But this flexibility came with trade-offs. Storage efficiency was one of them. Junk silver took up space. A significant amount of face value required physical volume. For those holding large positions, storage became a logistical issue. Weight was not the problem. Bulk was. Then there was complexity. Unlike bullion, junk silver did not trade in clean ounces. It traded in face value. Where mattered. Calculations mattered. A dollar in face value did not always equal the same amount of silver depending on condition. This complexity discouraged some buyers, especially those seeking simplicity. Purity was another limitation. At 90% silver, junk silver was not $999 fine. For buyers focused purely on metal content, this mattered psychologically, even if the practical difference was small. Refiners cared about purity. Some buyers did too. And yet, despite these drawbacks, junk silver continued to attract steady demand. Why? Because it behaved differently when systems tightened. During periods of rising premiums, junk silver often resisted extreme price distortions. During liquidity stress, it remained tradable. During uncertainty, it benefited from trust earned over decades, not promised by design. There was also a risk few discussed openly. As silver prices rose, the temptation to melt junk silver increased. Refineries paid for metal, not history. When shops became overloaded with inventory, selling to refiners became easier than selling to collectors. This had happened before, most notably in the late 20th century, when millions of historic coins were permanently destroyed. Once melted, they never returned. This created a paradox. Junk silver was both abundant and fragile, widely available today, yet irreversibly finite tomorrow. Its long-term scarcity was not theoretical, it was mechanical. Those who understood this did not view junk silver as obsolete. They viewed it as structural insurance, not against price movements, but against market dysfunction. It was not perfect. It was not elegant. It was not modern. But it had survived every monetary transition thrown at it so far, and that survival carried weight. As the analysis moved forward, the comparison became sharper, because while junk silver excelled in flexibility and trust, modern bullion promised something different: efficiency, purity, and alignment with institutional systems. The question was no longer which one was better. It was which risk mattered more. Silver bullion: efficiency, purity, and the illusion of simplicity. At first glance, silver bullion appeared to solve every problem junk silver introduced. It was clean. It was pure. It was uniform. 1 ounce was 1 ounce, stamped clearly and backed by a recognizable mint. For many buyers, this simplicity felt reassuring. In a world already full of uncertainty, bullion offered clarity. But clarity, he understood, could also create blind spots. Bullion did not emerge organically from monetary history. It was engineered, designed for investors, manufactured to meet demand. And while that design made it efficient, it also tied bullion closely to modern market infrastructure. This connection was both its strength and its vulnerability. Purity was bullion's most obvious advantage. At 0.999 fine, it required no explanation. There was no conversion math, no wear adjustment, no historical ambiguity. Value could be confirmed instantly. For institutions and serious capital holders, this mattered. Precision reduced friction. Storage efficiency followed naturally. 10 ounces of bullion occupied far less space than an equivalent amount of junk silver. Bars stacked neatly, rounds stored cleanly. For those managing larger allocations, this efficiency translated directly into lower logistical costs. Space, after all, was not free. Generic bullion products also often carried lower premiums, at least during calm periods. When demand was balanced and supply was ample, rounds and bars could be acquired close to spot price. For buyers focused on maximizing ounces per dollar, bullion appeared optimal. Government-minted bullion coins added another layer. Products like American Silver Eagles and Canadian Maple Leafs carried global recognition. They were trusted across borders. Dealers accepted them quickly. In normal markets, they moved easily. Yet beneath this efficiency sat a structural dependency that many buyers ignored. Bullion premiums were not stable. They were reactive. When demand surged, during inflation scares, banking stress, or geopolitical events, bullion premiums often expanded sharply. Mints struggled to keep up. Distribution bottlenecks formed. What had once been a low premium product suddenly carried a significant markup over spot price. The problem was not paying the premium, it was recovering it. When conditions normalized, those premiums often compressed. Sellers discovered that what they paid in panic was not always returned in calm. The metal remained silver, but the entry cost lingered. Divisibility was another overlooked constraint. Large bars were efficient to store, but inefficient to liquidate. Selling part of a position was not always possible without selling the whole unit. In theory, this was manageable. In practice, it reduced flexibility. Timing mattered. Size mattered. Precision was lost. Counterfeit risk also entered the equation. As bullion demand grew, so did the incentive to fake it. Sophisticated counterfeits became more common, especially for high premium government coins. The verification added cost and friction. Trust shifted from the object itself to the systems used to authenticate it. This was a subtle shift, but an important one. Bullion relied more heavily on modern verification infrastructure. Testing devices, dealer expertise, mint reputations. When systems functioned normally, this was not an issue, but reliance itself was a form of exposure. There was also a behavioral component. Bullion's clean appearance and standardized form encouraged buyers to treat it like a commodity rather than a strategic asset. Accumulation became mechanical. Decisions became price-driven. Exit planning often came later, if at all. This was not inherently wrong, but it carried risk. In periods of stress, markets did not always reward efficiency. Sometimes they rewarded adaptability. Sometimes they rewarded trust built over time. Sometimes they rewarded assets that could function outside institutional frameworks. Bullion excelled within systems. Junk silver often excelled outside them. This distinction was rarely discussed, yet it defined outcomes when pressure increased. Bullion was not flawed, it was powerful, but its strengths assumed conditions that did not always hold. Liquidity assumed functioning markets. Premium recovery assumed normalized supply. Verification assumed intact infrastructure. When those assumptions failed, bullion behaved differently than buyers expected. For serious investors, this realization was uncomfortable because bullion felt modern, it felt rational, it felt aligned with professional capital management. And in many scenarios, it was. But when systems tightened, bullion's advantages could narrow quickly. The analysis was no longer about metal, it was about dependency. And dependency, he knew, was where hidden risk lived. As the comparison moved toward its conclusion, one truth became unavoidable. There was no universally superior form of silver. There were only forms better suited to specific objectives. Understanding that distinction was the difference between ownership and strategy. And strategy, not preference, determined resilience. The real strategy. Why the form of silver decides the outcome. By this point, the comparison was no longer theoretical. The differences between 90% junk silver and modern bullion were no longer cosmetic or emotional. They were structural. And structure, he understood, was what determined outcomes when conditions stopped being friendly. The mistake many buyers made was asking the wrong question. They asked which form of silver was better. The correct question was which form of silver was fit for purpose. Silver was not a single-use asset. It did not serve one function. It served many, sometimes simultaneously. It could act as insurance, liquidity, a hedge against monetary instability, or a balance sheet reserve. But no single form of silver performed all of those roles equally well. That was the heart of the issue. When premiums were low and markets were calm, bullion appeared superior. Its efficiency, purity, and simplicity aligned well with modern financial thinking. Capital density was high, storage was clean, accounting was easy. In these conditions, bullion behaved exactly as expected. But markets did not remain calm indefinitely. When volatility increased, the priorities shifted. Liquidity became more important than efficiency. Flexibility became more important than purity. Optionality mattered more than optimization. This was where junk silver re-entered the conversation. Its fractional nature allowed partial exits. Its recognition reduced friction. Its pricing often resisted extreme premium distortions. In local markets, it moved even when institutional channels slowed. These were not advantages during good times. They were advantages during constrained ones. The comparison revealed a deeper truth. Silver behaved differently depending on how stress entered the system. In inflationary environments, premiums mattered. In liquidity events, divisibility mattered. In trust crises, recognition mattered. In storage constraints, efficiency mattered. No single form dominated across all scenarios. This exposed the weakness of single-form stacking strategies. Buyers who held only large bullion bars optimized for one condition while exposing themselves to others. Buyers who held only junk silver gained flexibility but sacrificed efficiency and simplicity. Both approaches contained blind spots. The disciplined approach was neither extreme. It was layered. Layering meant holding different forms of silver for different outcomes, not because diversification was fashionable, but because future conditions were unknowable. A resilient strategy acknowledged uncertainty instead of pretending to eliminate it. This was where serious decision-makers diverged from hobbyists. They did not choose assets based on preference. They chose based on function. They asked how an asset behaved under pressure, not how it looked in storage. There was also a quieter risk forming beneath the surface. As silver prices rose, physical supply tightened. Coin shops became overloaded. When margins compressed, the temptation to liquidate inventory to refineries increased. Refiners did not preserve history. They preserved metal. Once melted, constitutional silver was gone permanently. This had happened before. Entire generations of circulating coinage had vanished during prior price spikes. What survived did so only because it remained in private hands. This meant that junk silver's long-term supply was not just finite, it was vulnerable. Paradoxically, this made it both common today and scarce tomorrow. Bullion faced a different kind of risk. Its supply could expand, mints could produce more, bars could be cast. But this expansion depended on industrial systems functioning smoothly. When those systems slowed, bullion availability tightened quickly and premiums followed. Both forms were exposed, just in different ways. The conclusion was not dramatic, it was disciplined. Silver was not about prediction, it was about preparation. The investor who understood this stopped arguing over superiority and started designing resilience. They held bullion for efficiency and long-term balance sheet strength. They held junk silver for liquidity, flexibility, and transactional optionality. They did not expect one form to save them in every scenario. They expected their strategy to adapt. This reframed the original question entirely. It was not 90% junk silver or silver bullion. It was, what problem am I solving? Once that question was answered honestly, the choice became clear. And for those who took the time to think structurally rather than emotionally, silver stopped being a product and became what it was always meant to be, a strategic tool.